So, bring this thing to life. We're going to look at regulation. And then, oh, I did the wrong one. This one. All right. So here are the types of institutions. Oh my God! Types that help circulate money and get money and things in the right places in the right hands, hopefully. So this is our marketplace. So one of the ones we're going to focus quite a bit on are depository institutions. And those come in different forms. Savings and loans, which kind of had some problems back in the 80s, mutual savings banks, and credit unions. How many of you are credit union members? That you bank at a credit union? 1, 2, 3? That's it? Yeah, okay. So credit union's a little bit different than a commercial bank house. So in theory, what does a credit union do differently?
Is it all credit unions are together?
All what are together?
Like all credit union banks?
No, they're actually not together historically. That's kind of an interesting side note. But so they are a little bit different. They're not lumped together. How is a credit union a little different? Who else was a credit union? What credit union do you remember of?
Vista.
What's yours? Golden Plains. And what sort of people? Was it for a particular industry or anything? Because a lot of times the credit union started off as like the teachers union or something like that, or teachers credit union. Who else did they have a credit union? Do you remember what's yours called? Premier Credit Union. Yeah, that's another one. So credit unions have evolved over time. They started off that they're kind of like member owned in a sense, that your deposit is actually a share of ownership of the bank, of the credit union. So you are collectively owning the bank in terms of kind of membership shares. So you actually own a piece of the bank, so to speak. So in theory, it's kind of like a nonprofit, but over time, it's slowly evolved into looking closer and closer like a regular bank. But a lot of times, you'll find some kind of member-type benefits at the credit union. And most of the credit unions will take money from all kinds of people, but sometimes they're still restricted. Like, in order to have started an account, you had to be a member of the Teamsters Union or something, or the Teacher Union, or whatever is traditionally how they started. All right, and then we've got these contractual savings institutions. Insurance companies are the biggest, and some government retirement funds. Right, so life insurance, they are paying in premiums. Some of those insurance policies pay a little bit of a return. It kind of acts like a cash value. How many of you have cash value for a life insurance policy that you remember? Whole life insurance policy, there might be a little cash value. If you don't have it, that's good, because I don't recommend those types of policies. They're basically a ripoff, especially at your age. You should be in a term policy rather than a whole life policy. But nonetheless, that's a way that insurance companies make money. You start paying your premiums for a life insurance, which, by the way, is really death insurance, right? So if you're 23 years old, you'd be making premiums for the next, Lord knows how long, 50 to 50 years. That insurance company's collecting your money the whole time. That's kind of like a bank, right? So they're collecting their money. They're going to be reinvesting those funds into other things. And so that's the role they play. And then finally, these investment intermediaries, finance companies, GE Finance, consumer loans, commercial paper, money market mutual funds. If you look at the mix of what they have, we start to see the different roles that they play. So with savings and loans, traditionally, it was all home mortgages. Almost everything was a home mortgage. And then they slowly get into cars, and like I said, a lot of the S&Ls went under in the 80s and became other commercial banks, swallowed them up. So business and consumer loans, mortgages, U.S. government securities, that is the majority of action here. Credit unions, again, more people focused, so car loans, personal loans, other sorts of things that are going on at the credit union. And then bonds, they're active in the bond market, consumer loans. All of these have various types of financial assets, but these are kind of hitting on the things that they typically invest in. And what you find, the things that you're investing in are things that match the term. So life insurance, longer term, they're going to have longer term stuff that they're investing in the bond portfolio. Whereas if it's something with a quick turnover, then the type of assets, like if we look at commercial banks and it's your checking account deposit, they're going to have that reinvested in very short-term stuff because they have to keep it liquid, right? So the term of the assets that they have will usually match the type of activity that they're running their business. All right, questions or comments there? So we've been talking about all these this semester. This is still chapter 2 stuff. Here is the composition. So commercial banks, who's the big dog over here? Commercial banks. Check out the difference in composition back to even 1980. Right? So this has changed over time, over this 30-year run from 80 to 2010. One of the reasons we see a concentration of activity here is due to the government. The government has found it easier to bail out banks if there's only a handful of them. That's kind of maybe not a completely fair statement, but it's kind of true that they continue to add on more and more restrictions, squeezing out the little banks, little mom and pop. The country used to be filled with bunches of mom and pop banks that were just local rich people usually that said, oh, let's start a bank, and a couple of the people that have some sort of small hometown bank. Well, as regulations and restrictions, it becomes more and more costly for the mom and pop places to keep up with all the regulations, and so they end up selling out. And then Wells Fargo gets bigger, and JP Morgan Chase gets bigger and bigger, and then so we have lost a bunch of banks over time. And so that's part of why we see this concentration of dollars up in commercial banks. All right, questions or comments there? All right, so regulation, why do we have it? Well, we talked about that last time with adverse selection and moral hazard. To try to, one of the purposes anyway, is to try to equalize the information playing field. This is what food labels do for us. I can borrow your milk here. This little guy is not done by a free market process. The government forced producers to put on a standardized label. Why? Because they wanted to raise restrictions? No, they thought it was in the public's best interest that the marketplace would be more efficient, so that if you are lactose intolerant, you won't buy this sucker, right? If it just had a black label that said, yummy liquid, and that was it, you might accidentally buy this, and you're lactose intolerant, and boom, you cause problems. You would have never bought it. So it kind of creates some waste if there's asymmetric information in the marketplace. And so the government is a good place for us to help equalize the information playing field. When we get into these big banks and big corporations and stocks and companies, the reporting of financial information has become standardized so that it's easier for us as the investor to shop different companies, right? So they have the standard format for us to do. That is on the SEC side. All right, so here's some other reasons. You can read those. Now, why would this be a good thing? Restrictions on entry. As you know, I'm kind of a free market guy, so I wouldn't normally be supporting something like that. But maybe there's that makes some sense in some regards. Why in a bank situation would there be some restrictions on entry? that you go through this chartering process. What's that? Yeah, so properly qualified to have a bank. If we're dealing with other people's money, and one of the roles of the government is to protect the general public or protect the public interest in some way, shape, or form, then it might be possible for people to get involved in an investment activity that don't actually have the goods to back it. Does anybody know what Ponzi scheme means? Right? That is one example. So old Bernie Madoff was able to collect a bunch of people's investments. It'd be kind of the same thing with the banking industry, right? Hey, put your deposits on hold with me, and then they go out and do something else with those funds. So we want to ensure that the people who are starting up a bank have the right amount of capital, the right amount of backing to be able to run a bank sufficiently. Okay, any other questions, comments on that list? What's a bank run?
So they just close and keep all your money?
No, not quite, but it's a threat of closing. It's related to closing. What was a bank run? Imagine somebody running to the bank. Wait. Withdraw all their money, yeah. So rumors start that the bank is going under or something, and people run to the bank to withdraw their money. As we're going to find out, is all their money there? No, right? And that was one of our macro topics that we'll come back to later. So deposit insurance. So here's your long list of government agencies: Securities and Exchange, Commodities Futures Trading Commission, Office of the Comptroller, Currency, National Credit Union Administration, State Banking Insurance Commissions, Federal Deposit Insurance Corporation, the Federal Reserve, and the Office of Thrift Supervision. So each one, savings and loans, commercial banks, they fall under, depending on what type of business you're running, you'll fall under a different regulator. Yes?
When I go into a bank, like I see FDIC covered up to like 250,000. I mean, if you have more than that, they'll only cover to.
Yep, you'll be screwed. On that account, yes. Now you can open up another account at a different bank, and that will be insured for 250 also. But each individual bank, your account is limited to the 250,000. What if you have multiple accounts on the same thing? They're not covered. You got to have them at.
One name, one account.
Yep, at each institution. All right, so here's what these guys do. A lot of what they do is examine the books. So when the auditor's coming, they're usually freaking out. The banks that I worked with, they had to have all their I's dotted and their T's crossed. They're going to get a bank audit. They're going to pull files randomly out of the file cabinet or digitally. And did Susie Q fill out the application? Yes. Did this happen? Did Susie Q get told of her rights of the 3-day right of rescission? Yes. So, boom, boom. And you add it. Are all those documents, all the BS documents that did you sign here, did you sign here? Somebody is actually going to go through and check that file. They don't check all the files. They'll randomly select files out of a file drawer. And if you don't have your I's dotted and T's crossed, then you'll get hit with a fine, potentially. At first, you might get a warning or whatever. They're going to start to keep track of you on whether you're a repeat offender or not. And ultimately, it can cause you to have to keep more money on hand at the bank. Banks make money by taking people's deposit and then loaning it out. So one way they can penalize them is to say, hey, you normally could lend out 90% of your money, but now you can only lend out 85% of your money because you're not keeping good files. You need to fix your systems, and then once they fix their systems, they can maybe get back into business like they were before. All right. Any questions there? I know that print's kind of small, but gives you each one a little dose of it. Time to get into money. Money. Let's see. I can't remember if I want to start off with this one. I think I want to start on the board. So chapter 3 is defining money. Again, pretty much a review of macro class. So we're going to kind of blow through some of this stuff as a fairly quick review. I think you guys are fully capable of reading these chapters and get most of this. So, money. 3 purposes of money. So I will use the symbol 2 strikes of the dollar sign for money. And then this is kind of my neat invention that I did before. If I say dollar, I'll put 1 strike through. So dollar, see how it looks like an E? And then this looks like an M for money. Very clever. Just thought I'd let you know that this is something I hold back for this. So 3 purposes of money. All right, number 1, medium of exchange. 1 purpose is a medium of exchange. So this eliminates barter. Eliminates the need. It's not to say that it eliminates barter, but it eliminates the need for barter. Bartering is trading good for good. I'd like to buy 3 chickens. Here's 3 gallons of milk for 3 chickens, or whatever. And we can do a trade. But money serves as a medium of exchange, kind of that intermediary medium of exchange. In order to function properly, what does money need to do to really act as a medium of exchange well? Be accepted by everyone, right? So we kind of want it to be, universally accepted. So other people want it. What are some other things that's nice about our money? I mean, you can think about currency in this way, but you don't have to, because as we will get into later today, it goes beyond just currency, right? So what else is a good function to make this stuff work properly? Universally accepted. What else is going to make it healthy? What's going to make it move better, work better for us? Easy to use, easy to carry. Yeah, that was some problems with coins back in the medieval times, where all money was coin. And then you've seen it in the shows, right, where, oh, I'll pay you $100. Wham, hits the guy on the side of the head, bag of money, because it was like such a weight. Or here, I want to pay you for your mortgage. Here you go. And so money didn't function as good as it does now with this, let alone with the technology of our ability to access our accounts with this. Or, yeah, I do pass them around in personal finance class, actually. But I don't have it all set up. And then this, checks, right? So which one of these 3 are money? All of them. Wrong answer, actually. I tricked you. Just the cash is actually money. Why?
Because the other 2 may not be good.
Okay, good. That's right. Yeah, so the check is not money. The physical, so this and this have a big difference. This one's money, this one's a piece of paper that can be used legally to draw on your checking account. The checking account deposit is money. The check is not. The physical check is just an instrument to suck it out of there, a potential way to get the money out. But the money is actually the deposit, the amount that the bank says you have in your account. Same thing with this one. It's not the card. The card isn't money when I compare these 2 things, but it's the access to the account. The deposit account is the money. This is just a device to access it, to transfer it, okay? So when we add up money, we take the value of the accounts. We don't take how many, checks are out, unwritten checks are out there, because that wouldn't make any sense. So that's a distinction there for money. So we also have, you talked about the weight, so easy to carry. Let's put that on here. Universally accepted, easy to use. Just to kind of say coin versus bills, for instance. Durable, yeah. We want it to be some sort of long-lasting, although cigarettes in jail aren't quite as durable as some, but that can also be used as money. And then divisible is nice. So when I had to pay with a chicken and I wanted only a smaller fraction, I couldn't cut off the leg of chicken and say, here, I'll pay with the leg of a chicken if you're trying to do live chicken. But here, we've got 20 and a 10 and a 5 and a 1. So the number of units are divisible into easy parts that make it easy to use. So that's kind of nice. All right, number 2. A unit of account. A unit of account. So this is used to measure relative value. And it also reduces transactions costs. Because it serves as a unit of account, the marker producer, the bottle producer, and the bag producer could all express their profits of their company in terms of how many bags they made. Oh yeah, we did about $100,000 worth of profit in bags. I said dollars, and I can't even count myself. We did about 100,000 bags worth of profit. We did 100,000 bottles worth of profit. We did 100,000 markers worth of profit, right? So by having everybody express in different things, which one of those 3 companies was more profitable? I don't know, right? So by quoting everything in money with a standard unit of account, it allows us to more easily measure relative value. The same could be true if this watch was $400 and this watch was $800. Who's got the nicer watch? Who's got the higher quality watch? Likely. Probably Dallas does, right? So the dollars help reflect the quality of it as well and helps measure relative value without actually having to test, well, let's see what your metal's made out of it. What are your components of this and that, and how does it run, and like learning the engineering of it. We just know the dollars. If that one's more expensive than this one, then likely it's higher quality, it's higher value, and especially if we know the sales, if other people are doing it. Okay, and number 3. I think I'll just squeeze this in down here. A store of value. One of the purposes of money is to be a store of value. If I store this $10 bill in my wallet tomorrow, how much is it going to be worth tomorrow, roughly? Is it going to buy me the same amount of goods as it did before? Tomorrow, from today to tomorrow. Probably, right? Unless we're experiencing hyperinflation of some sort, then even on our 3% inflation or 4% inflation, it's pretty stable, right? So money serves as a store of value. It might really suck as a store of value, especially in inflation, because if we hold our wealth as money as opposed to stocks, bonds, classic cars, and homes, right? Those are other assets that you can buy. You can buy money, currency is an asset, shove it in your mattress, and if you put $100,000 in your mattress, 30 years from now, how much money are you going to have? 100,000. It had a store of value of measurement of 100,000. But as we know, as you go to the store, you're not going to buy $100,000 worth of goods because of inflation with prices going up. So while it is a store of value, if there's inflation going on, it's a terrible store of value for wealth creation. So store of value, it's a convenient way to store wealth. Sucks as an investment, though. That's why I use the word convenient. It's awfully convenient to just put this in our wallet and as a store of value. It's convenient, but not the best way to build a retirement fund, that's for sure. Okay, questions or comments there? All right, so how much gold will the government give us for this? $20 worth? Go to Uncle Sam, will they give you $20 worth of gold? No, they'll probably tell you to go to the corner store and buy $20 worth of gold, but the government's not going to give it to you. They're not going to. So the government prints these things off, but there is no gold backing it. So we got away from the gold standard in 1971, partially with Richard Nixon, and then officially off of it, I think, in 1973. So we haven't had dollars connected to gold for about 30 plus years, pushing 40 years. So there's nothing back of this. If you, anybody remember what it says on the back when you're holding one of these? In God we trust. That's all you got going for you, not the government. It's not in government do we trust, but in God we trust that this thing will be worth something tomorrow or next week. Because governments have been known to run the printing press when they need more weapons or stuff. Right? So if the government's not being responsible with these things, then it can be cause some problems. All right, so that is called fiat money. So note, U.S. currency is fiat money, which means unbacked currency. Unbacked currency. It's not tied to gold. It's not tied to anything. Just, yeah, it's tied to hope. So government declared it. Government declared legal tender is what it is. By law, they say, hey, this stuff, just trust me, this stuff's money, okay? Just trust me. You can use it, just trust me. So it's built on this trust that if the government misbehaves, can disappear. So countries that go through hyperinflation where they've mismanaged their currency, all of a sudden the people out there are like, you know what, our government sucks with their money. That US government's always been pretty responsible. Let's start using these dollar things. Let's use these things instead of our country's currency. So Zimbabwe is a classic example of that. They went through periods of hyperinflation. They started using the American dollar instead. Because now the currency's fixed. And so they know that there's no monkey business with the government, the Zimbabwe government, printing off these things, because these things are controlled by the US government. Now another thing is that the government declares it as legal tender and forbids other currencies. You can go to jail if you start trying to pass the buck, like, oh, I just have these Russ McCullough bills, and put your face on it and say, these are worth whatever, you know, and you see these for coupons and stuff. But if you actually start to try to develop your own currency, there's cases where people have been charged and put in jail with doing their own currency. So in other words, the government has a monopoly. No pun intended, they've won the game already by declaration. The government has a monopoly on money. Literally. They will throw you in jail if you try to compete with them. This is why they're really bothered by Bitcoin. We'll talk a little bit more about Bitcoin later, but what's true about Bitcoin that you know about it? I've talked in a few classes about it roughly. Why is Bitcoin able to kind of get around the monopoly power of the government? It's online, right? It's not, so it's completely online and it's anonymous. You can't track who's doing it with the monopoly, with the money. So there's no way to tie it back to the chain of who started it even. In fact, nobody knew who started it for a long time. The guy who kept silent, the creator of Bitcoin. And so I've lost track of exactly where that debate stands, but the government's not too happy when people start another currency. As people start to use another currency, of course, who loses power? The government loses the power of Janet Yellen changing the money supply and pulling the strings of the economy. All right, so that's a couple notes on money. All right, so let's get to these official definitions. I think I'm going to go to the PowerPoint for this.
I had a question.
Yeah, go for it.
So you said Zimbabwe uses the dollar. How does their government get more dollars, or how do
They had started to use more dollars, and I can't remember if they're still using part of it now. So the government doesn't, they have to get dollars the old-fashioned way. They have to earn them. They have to tax them. So, and they haven't been taxing people in terms of that currency, as far as I know. That the government didn't start officially adopting US dollars. But on the black market, people just started trading dollars anyway amongst themselves.
So they still use their currency?
Yeah, they have their currency and the other currency. Yes, they're kind of running in tandem. But basically, nobody had any faith in the Zimbabwe dollar, so it just kind of collapses. It almost becomes meaningless. All right, so M1, M2. You guys remember these from macro class? So M1, currency, traveler's checks, demand deposits, other checkable deposits. So these are both kind of demand deposits and checking account deposits. Anything that you have pretty easy access to falls into the government category of M1. So we talked about liquidity last time, how easy it is to turn your classic car into something else, or how easy it is to turn it into cash. And so M1 has components of it that are deemed to be pretty liquid. So if you have money in a savings account, how many of you have a savings account and a checking account? Okay. When you move your money from your savings to the checking account, what are you likely to do with it? Spend it, right? So by the government measuring checking accounts as opposed to savings accounts in this category, we're getting a feel for money that's ready to be spent, right? The amount of money that's kind of available for transactions. Okay, questions on that one? M2, most important component of M2 is the first one, M1. So we're just adding on to M1 with other types of assets. So all of the components of M1 plus small denomination time deposits, those are your certificates of depression, the CDs. So the 3-month CD, what's small is if it's less than $100,000. So if you have a CD that's less than $100,000, it's going to be counted in this category. There's another category of M3, and then there's another one called L or something. And so these monetary aggregates keep getting bigger and bigger, and then they add in the large denomination later. We pretty much just focus in on M2. So now we've got your savings account deposit. money market deposits, money market mutual funds. So all fairly liquid things that people use for transactions. It's just that M1 is a little more liquid than M2. So if you look at your savings account deposit and your checking account deposit, both of those are going to fall into this M2 category. All right, any questions there? What were people investing in when you're in a money market mutual fund? What kind of stuff? Treasury bills, short-term treasury bills, right? So, which is kind of what a T-bill is, but short-term maturity government bonds, 3-month bonds, whatever. All right, so here is our 2011 M1. 1,935 billion, otherwise known as, how would you convert this number? 1,000 billion is equal to 1 trillion. So it's 1.9 trillion. What's the GDP for the United States? Roughly, not looking for an exact number. Gross domestic product for the whole United States, all the transactions that take place, roughly, what is it, $1 zillion? It is in the millions, trillions, or billions, or zillions? Trillions, okay, good, we're on the right track. 100 trillion, 2 trillion, 50 trillion, 20 trillion, 15 trillion, 16 trillion, 9. Nobody's jumping out.
Hot or cold? 2.
Hot or cold? Higher. Lower.
80.
There's a little bit higher. All right, so somehow we went from 400 to 15, and now all of a sudden we're basically on break. So the United States economy is running about $16 trillion, and so let's call this 2 trillion of it is off of M1. And so that money gets spent over and over, as was Milton Friedman's concept of the quantity of money, the number of dollars in terms of accounts that are out there, getting spent over. I go run to Walmart. Walmart pays their employees. That employee goes out to Applebee's. Applebee's employee gets a tip of the waitress. The waitress goes and spends it at Best Buy, right? And so that spending, those dollars get spent over and over during the economy, making up our total value. Now, once we have the savings deposits, we're up to 9 trillion. So a little over half of our gross domestic product, all the dollar value of activity coming up in this 9 trillion range. All right, questions there? So check out the amount here. This is kind of the lion's share, savings deposits and money market deposit accounts. So most of over half of our M2 is being held in that way. M1 was 2 trillion of the 9 trillion. Remember, M1 is in M2, so we're adding this number plus this number plus this number plus this number equals M2. So by quite almost threefold, the savings deposits have it over M1, checking account deposits and cash, currency. Cash and currency up here, we've got 958, so almost 1 trillion worth of these guys running around throughout the world, right? About $1 trillion out there. Okay. So this thing goes a little Venn diagram on you. M3 is another monetary aggregate where they add in large time deposits, and then there's something else I have it onto that, I can't remember. We don't deal with this one very much in this class, but it's just important to keep in mind M1, and then that is inside of M2. So does it matter? Oops, I thought the figure was, oh, there it is. This is the one I wanted to get to. Money growth, M1, M2. Which one's more volatile? M1, right? And in some cases, they're moving in different directions. If we get into 1995 range, notice that this one's going up, but this one's coming down in general. And so over time, from this 1960 time frame to 2010, M2 has shown a little bit more stability. If we go back to 1960, ATM machines, yes, no. No. 1970, ATM machines, yes, no. Not so much. You guys probably wouldn't know this as much as I do, because this is when I started going. I was born, by the way, in 1971. ATM machines, 1980? Starting to. Yeah, this was the start of ATM machines. So as we start to have financial innovation, what happened between M1 and M2, the distinction? As we start to have ATM machines, what did people do differently in 1960 when they were thinking about the big weekend coming up? What did they have a big weekend? Took out money. They needed lots of cash, right? Because not every place would accept a check, and you couldn't run to the ATM machine and get more cash. So Fridays were a big cash withdrawal time, and you'd have a lot more ability to track how much spending was going to go on in the United States by looking at M1. M1 kind of gave you a lot of data in terms of spending. But as financial innovation comes along, we get into ATMs, online banking, using our stock market portfolio. We could pretty much write a check and buy a car against our stock portfolio with Goldman Sachs, right? You couldn't do that. It was actually illegal. That wasn't even around back then. So the fact that you can draft on your stock portfolio has led to this increasing variability. Look at how noisy this is. 85, a lot tighter, right? You see that? The band is a lot tighter. That's due to the financial innovation. M1 became a lot noisier when it was pretty easy to slosh between my savings account, my checking account. I can just pull up my smartphone and move the money around, no big deal. And so that's what gives the volatility to M1 and why it's largely kind of ignored as a measure of money. So M2 is the one that's focused in on by the Fed. Okay, questions or comments there? Yeah.
Why did it dip so low in 97, 96, 97, that area?
I think due to more innovation. This is a little recession here. So we had the 2001, the dot-com bust was partly going on here. I don't know if that contributed. So we had one of the longest expansionary phases of the business cycle. So the economy was pretty good, and I think coupled in with the financial innovation. I mean, think about it. Internet, online banking, all of that's kind of happening in here. People are relying less and less on M1. So I think that's part of what contributed there. Anything else? All right. So,
I'll make it for you. I heard the sound.
So let's see. Any other questions? I got one other thing that I think we basically did it. Should we start Labor Day?
Yes. Yes.
Mark your calendars. You are getting out early.